When everyone thinks about the king of AI, the company that started it all, tons of credit goes to NVIDIA. And to be clear, I love NVIDIA stock for the second half, but with many semiconductor names in a bear market, not just a correction, but a full-fledged bear market, I thought this would be a great time to walk through some stocks I believe are not only buy the dip candidates in the AI space, but 6 stocks that I believe are set to dominate the rest of 2026 and beyond. And if you want to stay up with all of my portfolio trades and option trades, be sure to join my private investing community and get access to my private Discord. You can check out that link down in the description below. But when it comes to investing, particularly AI, I believe investors are missing something. The next phase of AI isn't just about faster chips or better chatbots. It's about building the infrastructure that powers artificial intelligence. Every new AI model requires more GPUs. Those GPUs require more networking, more custom silicon, more advanced manufacturing, more power, more data centers. In other words, AI is becoming one of the largest infrastructure buildouts we have seen in decades, and maybe ever. I believe that's where many of the biggest investment opportunities for the rest of 2026 are hiding. And yes, that still means chip companies can continue winning. So in today's video, we're going to be going through 6 companies that each play a critical role in the AI ecosystem and explain why I think they're positioned to dominate over the course of the rest of 2026. And as we jump into this first stock, do me a favor, click that like button down below. It really helps with the growth of the channel, and I truly appreciate it. And with that being said, let's jump into stock number 1, which is going to be Credo Technology, stock ticker CRDO. Not a name I've mentioned on this channel before, but over the past few months, it's one I've been watching and doing more due diligence on. Because after all, my goal is not to chase stocks, my goal is to buy high quality companies at great valuations. So when you think of Credo Technology, think of it this way. If NVIDIA builds the engine, Credo helps make sure all of those engine pieces can communicate with each other. As AI clusters continue getting larger, networking has quietly become one of the biggest bottlenecks. This is one reason I've been bullish on copper and have bought the COPX ETF in the past. But Credo is a different technology that can even speed things up even more. Thousands of GPUs need to exchange enormous amounts of data every second. If networking can't keep up, those expensive GPUs spend more time waiting than computing. That's where Credo comes in. The company specializes in high-speed connectivity solutions that help move data efficiently through AI data centers. Credo Technology saw their revenues explode during fiscal 2026, more than 200%. And even with those difficult comps going into the next 12 months, revenues are still expected to grow another 85%, which is quite impressive. Operating margins are above 30% for the company, which I love to see. And look at the free cash flow that has gone crazy, up 1,300% year over year. As hyperscalers continue expanding AI infrastructure, demand for faster networking solutions should continue growing alongside it. The company has already been delivering exceptional revenue growth, as we just saw. And if AI spending remains strong, I believe Credo still has a long runway ahead. In terms of valuation, shares of CRDO trade at a forward PE of 34 times next year's earnings, which is well below the recent average of 52 times. And if you look at it from a different angle, looking at EV to EBITDA, that's sitting at 29 times, well below their recent average of 44 times. Some may look at that 34 times forward PE and think it's expensive, but I don't think so, considering the company is expected to grow earnings over 70% this next fiscal year and another 50% the following year. That is incredible growth for that price that you are paying. Taking a look here at this image, you can see analysts rate the stock a strong buy with an average 12-month price target of $282 per share, implying more than 30% upside from current levels. And before we jump to stock number 2, do me a favor and leave a comment down below with your biggest AI conviction stock for the rest of 2026. Which stock do you have the most confidence in for the rest of the year? I would love to see all those different ideas down below, and maybe we could eventually do a future video with those. But with that being said, now let's jump to stock number 2, which is going to be AMD. While NVIDIA continues to dominate AI accelerators today and GPUs, AMD is becoming a legitimate second player. But when we start talking about CPUs, AMD is a powerhouse and one of the leaders in the market with the likes of Intel. But AMD has been taking plenty of market share. The thing about AMD is the fact that they are not trying to replace NVIDIA per se. It simply doesn't need to. The AI market itself is expanding rapidly that multiple winners can emerge. AMD currently has a market cap north of $800 billion, but EPS is set to explode this year, and stock prices are following earnings. Earnings are up nearly 60% in the past 2 years, and you can see here for 2026 they're expected to grow another 75%. As AI infrastructure expands, companies need both CPUs and GPUs working together. And just today, the company announced their first full AI rack to rival the likes of NVIDIA, and they already have customers lined up, such as Microsoft, Meta, OpenAI, and Oracle, to name a few. It will ship later this year, according to the report, and could be a game changer for the company moving forward. That creates multiple growth drivers for AMD over the course of the next several years. I think investors continue underestimating how large this opportunity really is. From an earnings perspective, as we already saw, nearly 80% EPS growth is expected this year, followed by 81% growth next year. And all of that trading at a forward PE of 36.8 times next year's earnings, which puts us well below a PEG ratio of 1, which I love to see. Looking here, you can see analysts rate the stock a strong buy with an average 12-month price target of $545 per share, implying 10% upside from current levels. But for me, I think we can hit over 600 by the end of the year. And before we move on to stock number 3, let me thank today's video sponsor, which is Gamma. Gamma has made my life so much easier because in my field, I give a lot of presentations. Whether it's webinars, workshops, or just presenting in front of a live audience, I'm constantly building new presentations and slide decks from scratch. Gamma assists in making it almost effortless to create beautiful and professional presentations. With Gamma, you can build powerful AI-generated decks instantly. All you need to do is go into Gamma, describe the presentation you want with certain facts, click Generate, and voila! You can upload documents with certain facts you wanted highlighted within the presentation. Or Gamma can connect directly to a number of sources, whether it's your email, Canva, you name it. Stop starting from scratch and start not only saving yourself time, but building some of the most engaging and professional presentations at the press of the button with Gamma. The best part, you can try it all out completely free for 14 days when you use my link down in the description below. Now with that being said, let's jump to stock number 3, which is going to be Broadcom, stock ticker AVGO. And Broadcom may be my favorite AI infrastructure company. Many investors still think Broadcom is just another semiconductor company. It's much more than that. Broadcom has positioned itself as one of the leading custom silicon partners for hyperscalers. This is something I have talked about for years being a long-term risk to that of NVIDIA. It's the fact that companies are going to start building their own chips. Who helps them do that? It's Broadcom. They are working with the likes of Alphabet, Amazon, OpenAI, Meta, and the list goes on. Instead of selling the exact same chip to everyone like NVIDIA, Broadcom helps companies design custom chips tailored specifically to their needs and workloads. Broadcom benefits regardless of which hyperscaler wins. But that's not all. On top of that, Broadcom also provides critical networking technology that connects massive GPU clusters together. So investors get exposure in two of AI's fastest growing trends, custom silicon and AI networking. When it comes to Broadcom, they're already one of the largest companies in the S&P 500 with a market cap north of $1.7 trillion, but also one of the highest quality companies as well. Revenues continue to grow, efficiencies are expanding, and free cash flow is off the charts as the company generated free cash flow growth of 22% just last year. In terms of valuation, right now shares of Broadcom trade at a forward PE of just 19 times. If you can believe that, for a company growing earnings 67% next year. Shares would be intriguing if they were only growing at 40% next year. And in terms of a price target, analysts rate the stock a strong buy with an average 12-month price target of $515 per share, implying roughly 35% upside from current levels. All right, let's look at one more chip stock with the like of stock number 4, which is going to be Marvell Technology, stock ticker MRVL. Another company benefiting from this AI revolution, which will have speed bumps along the way, but I also believe we are in the early innings. There will be plenty of winners, but not everyone will be winners, and that's the key. Because over the course of the next year, we are likely going to see the separation between the pretenders and contenders. Like Broadcom, Marvell is becoming increasingly important in the custom AI silicon and high-speed networking. The company supplies optical connectivity, switching solutions, and custom ASICs that are critical for next-gen AI infrastructure. Think of Marvell as a combination of a little Credo as well as a little Broadcom in a way. As AI clusters grow from thousands of GPUs into hundreds of thousands, networking becomes just as important as compute itself. That's exactly where Marvell thrives. While the stock has experienced plenty of volatility, I believe its long-term opportunity remains enormous if AI infrastructure spending continues accelerating, which we are again going to find out during this next earnings season we're going through. When it comes to Marvell, they have a market cap of $165 billion, and revenues have not only been growing of late, but accelerating in growth. Revenue growth over the past 12 months grew 42%, and the company is operating with a margin of 16%, and with operating cash flow growing 22%, all things we love to see. Earnings are expected to grow 42% this year and more than 50% next year. That's that acceleration. And shares trade at a forward PE of just 30 times, yet another stock with a PEG ratio well below 1. In terms of analysts, they rate the stock a strong buy with an average 12-month price target of $271 per share, implying 40% upside. Now with that being said, let's move on to stock number 5, which is going to be Taiwan Semi, stock ticker TSM. None of these companies exist without Taiwan Semi. Is it a chip company? Yes, in a way, but they're not designing. Instead, they're manufacturing. Every cutting-edge AI chip eventually needs to be manufactured, and nobody does that better than Taiwan Semi. Whether it's NVIDIA, AMD, Broadcom, or many custom AI chips being developed today, they all rely on Taiwan Semi's advanced manufacturing capabilities. As AI demand increases, foundry demand increases as well, and Taiwan Semi isn't betting on just one winner. It benefits from nearly the entire AI ecosystem. That's one of the reasons I continue viewing it as one of the highest quality semiconductor companies in the world, potentially a must-own. When it comes to Taiwan Semi, it currently has a market cap of $1.8 trillion, and revenues continue to climb higher and higher. Revenues have grown 38% year over year with an incredible operating margin of 56%, an impressive free cash flow margin of 26%. The company just reported very strong earnings results, with profits jumping nearly 80% and forecasts remaining solid. Looking at valuations, shares trade at a forward PE of just 18.7 times for a company growing profits more than 56% this year and 27% next year. But here's the catch. I believe 27% growth number is way too low, especially considering the company just reported a near 80% growth rate and increased estimates. In terms of analysts, they rate the stock a strong buy with an average 12-month price target of $517 per share, implying 30% upside from current levels. Now let's move on to our final stock, which is stock number 6, and this one's not a chip company whatsoever, but still a play on this AI revolution. And stock number 6 is going to be Sterling Infrastructure, stock ticker STRL. This may actually be one of the more overlooked AI investments. AI requires data centers. Data centers require roads, utilities, power infrastructure, site development, concrete, civil engineering. All of that has to be built before servers ever go online. We have seen the upside potential with big names like Cat, who is doing a lot of infrastructure around AI data center sites as well. Sterling has increasingly benefited from this wave of infrastructure spending as cloud providers continue building AI campuses across the country and across the globe. Companies involved in construction and infrastructure could and will likely see years of demand ahead. This isn't the flashy side of AI, but sometimes the companies selling the picks and shovels become some of the biggest winners. Sterling is the smallest company on this list of stocks we're looking at today, with a market cap just shy of $20 billion. Revenues, though, continue to grow consistently. But this year, we are seeing the increase in AI spending show up in the results in a big way. Revenues have grown nearly 40% year over year, and operating with a margin of 17%, and free cash flow margin sitting at 15%. Looking at valuation, shares trade at a forward PE of just 25.2 times for a company growing profits more than 75% this year and 30% next year. And now we've seen all 6 stocks, all with a PEG ratio below 1. In terms of analysts, they rate the stock a strong buy with an average 12-month price target of $920 per share, implying an impressive 41% upside from current levels. When investors think about AI, the focal point is becoming much more broad, as we are seeing that there's so much that goes into it, which is why I think the bigger opportunity over the rest of 2026 and beyond is understanding the entire AI supply chain, whether it's compute, networking, custom silicon, manufacturing, infrastructure, power. Every one of these areas needs to expand if AI continues growing. And that's exactly why these 6 companies we covered in today's video have my attention and why I believe they could dominate the rest of 2026. They're not all competing against each other. They're building different pieces of the same ecosystem. So with that being said, I hope you enjoyed the video. Make sure you join my investing community. Stay up to date with my market reports and trade alerts. When you join, click the link down in the description below. And if you enjoyed this video, again, show your appreciation if you haven't done so by just simply smashing that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.